All right, everybody. We are here with Moritz Seibert. I'm so excited to have Moritz on again. We had him on the trading panel last week. We have the trading panel every single week on Wednesdays at 2 p.m. We might have to change that time a little bit. I know Andrew's going to deal with another time change. He's been getting up very early to try to figure that out at the moment. But with the time change, we're going to have to see what happens there. But make sure you're hitting the notification button so you guys see when we are going live. Moritz had a bunch of great stuff last week. If you guys didn't see that, make sure to check that out. But last week on the trading panel, we talked about trend following. We talked about the ideas around trend following, the idea of loving your system through good times and bad times. The ideas of clients may not like you loving your system during the bad times, but you have to understand that's just how it works. I thought it was a phenomenal conversation with Andrew, Moritz, and Pavel last week. So definitely check that out. And we're excited to have him back today. Moritz and I talked a year ago. So basically a year ago, or sorry, 2 years ago now.
Longer than that, yeah, two, maybe even a bit
two
longer
years.
than that.
Yeah. It might even be almost 3. And so the last time we talked about his portfolio, how he was doing, and some lessons around trading. And so this time I said, hey, we should kind of go back and go through how you've done since then. So let's go back to 22. We're in the beginning of 22, where this is a point where I remember commodities started to take off. At that point, I remember also an interesting note as we were talking about clients the other day. The clients I had were, instead of, hey, I need some money for taxes, which is the usual one, I was getting, hey, I really don't want to take any money out right now because it was doing so well at that time. So basically, like, I would have to talk them out of that, being a bad course of action. However, it's like we were having a really wild period that year for a little bit. There was the Ukraine crisis with Russia. There's a bunch of stuff happening. So what was going on in your portfolio around that time, Moritz?
Well, that's exactly what was going on. A lot of that is distant in my memory. I don't obviously recall every trade, but I remember from 2022 that we had a fantastic start to the year. I think the first quarter was really phenomenal. On the trend program, I'm just having a look here, was just 3 really good months in a row. January, February, then March especially was strong. Then also April. And a lot of that had to do with what had happened or got unleashed in terms of price action as a result of the Ukraine conflict. Remember energy prices going higher. The grain markets were under a lot of stress. Wheat moving higher, wheat spreads exploding. There was a fear of a diesel shortage and heating oil shortage in Europe. Obviously, natural gas. Oh, let's not forget about natural gas. I mean, TTF, the European natural gas contract, roofing, going completely crazy. So yeah, this is what happened in 2022, and you kind of like when I look at the remaining 8 months, they were like, yeah, still positive, but most of the money that year was really made in the first 3 to 4 months. You could essentially have closed the books afterwards, and you wouldn't really have noticed anything. Um, but yeah, I personally do remember a lot of these commodity spreads going completely crazy. I've mentioned the grains to an extent, also corn. The people running location arbitrage programs between different grain markets, they had a difficult time. Also, remember we had, I think, I know this was during COVID when the gold spreads between London and New York started decoupling.
Oh, yes.
That wasn't during 2022. Yeah, and then I guess the big tailwind continued to be the rising interest rates in the US and really everywhere else in the world, but mainly in the United States. And we were short the bonds throughout all of 2022. I don't really recall that being different at any point in time. Short everything really, and that made a bunch of money, and continued to make a lot of money in 2023 as well.
Yeah, looking through it, I'm looking through some of the the trades over that year, seeing Wheat being another one that was a huge move at the beginning of the year. Canola was another one. I think
Mm,
soybean oil, yeah, soybean oil is down here. A lot of, and it was interesting because the currencies at the same time kind of decoupled from their normal movement, which would be, this is why trend following is very important, because sometimes, you're watching, if you look at the first quarter of 22, the dollar skyrockets in March. At the same time, oil and a lot of the commodities skyrocketed in March. So, the only way to really take advantage of that is to understand a trend, have a trend system, really just putting on trades and not saying, hey, this correlation doesn't make sense. You just continue to put them on. So, looking through all these, same thing with the bond market. The 5-year bond was one of ours that did well. 2-year, all of these. I mean, you go across the board, like a lot of the systems that were taking signals were just winners over and over again. And those trades, some of those trades started all the way back in November 2020, around the election time. So they skyrocketed at that point. You get flat. How do you handle being flat for that long? Would you ever just cut off all of your positions in Q1? I mean, I probably know the answer to this, but I think it's important for the audience to know the answer to this.
yeah, so the answer is a clear no. Unsurprisingly, I'm not in a discretionary way flattening the book only because I've had a great quarter or a great start to the year. You can't predict what the next quarter is going to be. Imagine you're closing the book at the end of March, and then April, May, June, and the rest of the year, they become even better. You just don't know that. So that is systematic trading. Quantitative rules-based trading is about exactly this: placing the next 1,000 trades, the next 2,000 trades without making any predictions, following the system. If your system has positive edge and a positive expectation, you should not be scared about placing the next trade. It should be completely independent of what your last trade did in the markets. Just continue doing the trades, size them appropriately. This is I think one of the background things that you just mentioned there with all the moves that have happened, some of which very surprising. Um, Make sure you're cutting your losers short. You don't want to be put in the mixer and into a position that causes you a big, big, big loss, because that's not only inconvenient, that may also be emotionally disturbing. You just don't want to be in that position, in that place where one market, one trade has such a big negative effect on your portfolio. It's a much better sleep at night if the portfolio is kind of like even keeled and you have risk distributed across all these different markets, which yes, can at some point correlate positively and um, create volatility, but that is something very different to me than risk, because risk is really the essentially the probability of a permanent loss of capital, of my core capital. So just that trade eating into that core capital base, which then at some point means that I can no longer place trades, are no longer in the same size. That's what I want to prevent. I want to be able to trade tomorrow, in a week's time, in a month's time, in a year's time, and forever, essentially.
Yeah, and getting those years, when you have that great return, I think the thing that a lot of people get into, and not to mention, like I would hear from clients, like, oh, we could have just cut it off right there, or you hear from like somebody, if you ever trade for an institution, they'll say, oh, we could cut off there. Like they think, certain people think that that's like a possibility, and it's like you really don't know exactly when that happened. Like if I wanted to psychologically do that, let's say like I'm get out of my systems, I decide like I'm gonna have a exit point, I would have psychologically done that probably in November 2020. November 2020, I'm sure for you as well as me, that was a very great month. Things moved a lot. I could have said, "Hey, I made a really great return this month. I'm going to just cut it here and wait till the next quarter, and then the next quarter you can then say, well, the market's a little high. I don't know if I want to buy here. These commodities have already run quite a bit, and you'd miss out on an entire year of returns. 2021 was a great year for most of the trend followers because you had this monster trend, and a lot of the commodity space, a lot of sectors did very well. The sector futures, a lot of things did very well that year. So once again, you can't really know. I think that's what hurts people in trading is that fear of the unknown.
Mm-hmm.
So how do you handle that fear of the unknown as a trader and just continue to put on trades, not try to overthink when you need to get in and out of things, and be able to just continue to take trades even though you made your year? Basically for us, a lot of us get paid either quarterly or yearly. You probably made your year at that point. You could have taken the year off and gone to the beach, but instead you continue to trade. So how do you get rid of that uncertainty so you can just continue to trade and hold your positions?
It's learning by doing, but also, that is the promise and essentially the agreement that I have with investors is that you're not stepping away from the desk and you're calling it quits in March. That wouldn't be fair. I also love the game. I like to continue building the track record, and I think that's one of our superpowers is that we as systematic traders are in a position, and that is what we do, where we hold a position way beyond the point where most discretionary traders would feel comfortable holding that position. And that essentially, and sometimes, gives you a chance to have an outlier price move, to move into the tail of the distribution, which is chaotic. So cocoa is the great example du jour, right? I mean, because that is what's essentially on a lot of people's mind these days. Exactly
It
1 year
is the
ago,
outlier.
it is the outlier. And a year ago, in March of 2023, front month cocoa prices were, I don't know, somewhere, I think less than 3,000 per metric ton. They're now north of 8,000 at the front month contract price. And so what happened is between March of last year and essentially the beginning of this year, the market moved from 3,000 to 4,000. A very nice upward sloping trend. Not a lot of hiccups, easy to follow, but a trend that's been going on for such a long period of time that produces profits, open trade profits in your account, I presume will have a lot of traders, discretionary traders, to take their profits and say, look, this has been amazing. Let's bank this money. We want to get out of that trade or reduce the position size because cocoa hasn't been making us money for the past 20, 25 years. And now all of a sudden it is making us money. So let's take the money while we're at it and not lose it again. And then, so when you do this, that is essentially then, if you lose your position, you're flat or you have a reduced position, you are now no longer exposed to the outlier by definition. But the explosiveness that has happened this year. It happened between January and right now. The market doubled from 4,000 to more than 8,000. And look, it'll be painful for most on the way down. Who knows what cocoa will do? I can't predict. Maybe it's going to go to 10K or 15K or 20K, or maybe it's going to go right down today. And we've seen the highs today or yesterday, and that was it. I don't know. If it's a quick reversal, then yes, the classic trend following funds that still have the position size on, who are like fully loaded on cocoa, they will have some pain and give back on that open trade profit. Actually, I don't want to say pain. I just use the word pain. I don't want to use the word pain. It's a reduction of open trade equity. And that to me and to many of my friends is something that we would like to frame in a different or view through a different lens than a loss on closed equity. So when you think, if you make the distinction, Jason, between we're initiating a trade today, if we're initiating it right now, then our P&L is zero. It can now either go up or it can go down. If it does go down, it'll essentially start costing me money. At some point, I'll stop it out. When that happens, with the initial stop, it will have eaten a little fraction and consumed a little part of my core capital. A little part is the important thing. I don't want that part to be a large part. That's the chip I played. It's a small part. But when a trade such as cocoa has made so much money and we're now sitting on open trade profits, I mean, legally speaking, you would say that yes, any loss that you now incur on that open trade equity is the same cash, right? It's the same reduction. It shows up in your NAV. But the way I frame this is it's kind of like I'm in stealth mode. Unless cocoa gaps in a discontinuity event down to 2,500, then that trade from start to finish, which is really the only thing that matters to me, trade inception, trade exit at some point. We don't know when the trade exit for cocoa will happen, but that trade in all likelihood is going to be a massively fantastic trade. It's going to be a great trade. And when you wake up in the morning and you view it that way, the question is only, well, how great is it going to be? Is it going to be amazing, 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 or just 1-star amazing? I don't know, but it's going to be a great trade. And this is what allows us, or me, to keep going with that thing, because it really can't hurt us anymore. We're going to take this to the finish line one way or the other, and in all likelihood, it's going to be a monster P&L maker.
No, I agree, and that's the thing that Richard Brennan was on today, and we talked the other day on the trading panel, and he mentioned, he said uncertainty is correlated to trend following, and that's in so many, you could use that in so many different ways. Uncertainty in the world when trends are starting to happen and so on, but I think it's also very applicable to this conversation, which is you're in an uptrend. You trust me, there's things still that go on in my brain that go, hey, it'd be nice to run out of this trade now. We've been in it for over a year. It's made a great return. I'd love to cut it and run. Maybe this is it. Like maybe it's topping. However, I have to always remember, I have no idea when a top will happen. I have no ability to predict that. I have no ability to predict a bottom or a top.
And you can't predict this. Sorry, you can't backtest it either. The only thing that works as your compass and your guiding light is the statistics and the sample size that you have produced based on historical analysis. So what you've backtested, hopefully in a professional way, is a system that has no discretionary inputs. And in the past, your system, and this is what you would see in the historical price chart, is a system that would have kept on and held on to that cocoa trade and to all the other trades that we've seen in recent years that have become outlier trades. We're still long orange juice, or I'm still long orange juice. Maybe some other funds are not. Remember TTF, Dutch gas. Amazing trade in both ways, by the way, to the top side and now to the downside. So that is what you tested. And if you like what you see in that back test, coming back to loving the system through good and bad, then you should really trade the system and not deviate from it, because now you're in uncharted territories. You're essentially now backing yourself again that you can outsmart the system and be better than that system. To some traders, I understand, or maybe I don't understand, but their reason is it's their makeup, their emotional, or their psychology. Not everybody is suited to being a systems trader and kind of like sticking to the rules and abiding by them. And some people just need it, that they kind of like do something on top of it and they play around with it. And I'm not saying it's, for me, it wouldn't be good. Maybe some people have an ability to improve it, but it's certainly something that you cannot backtest. But over time, I've just migrated to, at least as far as the trend following side and the core systems are concerned, I just follow these systems. There's just nothing that I could possibly do better than the system that tells me to be long cocoa.
Yes.
Look, I'm a European. I look at the cocoa market, and obviously, I would say, look, it's probably too high, or maybe it's going to rain on the Ivory Coast, and there's going to be enough cocoa, blah blah. So you think, yeah, it must be coming down, and whatever, it still continues to go higher. So,
and we all have feelings, and ideas, like once again, I know we're all normal people in the world. Some of us are most of us are pretty well read. We understand economics for the most part. We understand a lot of these things. So we have lots of ideas and feelings at times. And the feeling that you will always have as a trader is, hey, there's open equity. I'd like to run away with this extra $10,000 or extra, like extra 100,000, extra millions, when you're running money. Like it all sounds great. Nobody
That's right.
likes to see open profits on their thing. However, I know that to make this work, I'm going to have to give some back. That's just going to happen at some point. So if it stops here and it comes back, I'm going to give back a bit of that trade. That's going to always happen. I'm never going to get out perfectly at the top. I'm never going to buy at the bottom. I guess another point to bring up to you on cocoa is, and I didn't know this until recently, people were telling me that a lot of people, trend followers, took it out of their portfolio. Because it was so choppy all those years. And I posted I try to be as transparent as I can. I posted a chart showing every entry and exit for cocoa over the last, I don't know, probably about 8 years now. It was going back to 2016, I think. And there's probably maybe 10 trades on there. They're small losers, break evens, small winners, a lot of losers, over and over and over again, chop, 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 constantly. And once again, I didn't know people were taking it out of their strategies. I just thought of it as kind of this normal thing you go through with certain assets. There's chop that happens. There's certain things that are going to be ridiculous over time. And at some point, usually that leads to a trend at some point. And trust me, it's frustrating. I'm not saying as a normal person, I still see it. I think it was cool in Covell's book. He had a part of that book where he, what did he do? It was the Great British Pound, and it was somebody shorting the pound trade, and it was actual like picture of all their trades shorting the pound. And it's like chop, 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 it's just constant losers over and over and over again every time they got a signal. And once again, as a trend follower, you have to understand like that's going to happen at times. If you back tested your system, you're going to have to know that. Two, as a trend follower, like the years that was happening, the other thing I pointed out to is I had some great returns in some of those years. And because cocoa being one trade and one small loser doesn't do anything to my overall portfolio for the most part. And so we trade so many different assets because of this. So I guess the thing do you ever take anything out of your portfolio when you're getting chopped up in it? Or do you look at it all like the more diversification, the better?
Yes, the latter. So rather than taking things out of the portfolio, I'd rather focus on putting things into the portfolio, ideally markets that are uncorrelated and independent to the markets which I already trade. I trade two cocoa markets. I trade New York cocoa. I trade London cocoa. So on the Liffey exchange, or what is now the ICE Europe exchange, and New York cocoa and ICE US. They're not exactly identical markets, but almost close enough identical underlies so that they are very highly correlated to one another, but they're not perfectly correlated. So that just means that I get a teeny tiny bit of a diversification benefit by trading both markets at the same time, and I can spread my risk across both of them. And that also removes some idiosyncratic risk that may materialize in one of these markets. So I would say that is a good thing. And I would therefore not take any of these markets out of portfolio, especially not because, or only because of recent underperformance. When you think about cocoa and the way you analyze cocoa for the past 25 years, say, let's just say that on average in that market, as a longer term trend following trader, you're doing what, 1 to 2 trades a year? Okay, you get stopped out. It takes a while, at least for my system, it would, in such a market that just goes range bound, it would take a while for the system to go back in. So let's just say 25 years. If you had 1 trade per year, that's 25 trades. If you had 1.5, 37, 38 trades, whatever, something like that over a quarter of a century. Now, 38, let's just say it's the sample size is 38. I'm not sure in your system, maybe you can count the trade number on cocoa. That just isn't a lot. Like, this is nothing, statistically speaking, that would allow you to make any solid inference as to whether you should be trading cocoa or not. And certainly not that you should be taking it out of the portfolio. It is just not enough data for you to arrive at that conclusion. The only data that you have is the ensemble of all your trades, which now goes into thousands of trades across all your system, all done with the same parameters. Nothing is curve fit and over optimized, where now you're kind of like getting to something that has a statistical body of evidence where you can say, okay, for the system in aggregate, if I take every trade, the expectation is X, Y, Z, whatever your system is doing. But for a single market, you just cannot do this. So no, I don't remove markets because of performance, especially recent performance. The only reason, two reasons maybe, that I would remove a market from my portfolio: illiquidity. Not every futures market makes it. There's a bunch of futures markets that get launched, but that never become very large. Maybe because they are structured incorrectly. One example there, for instance, the ethanol market in the US isn't very liquid. Most of the stuff is still kind of like off screen, and there's some swaps based markets. They just, we would like to trade them, but they really aren't liquid enough for me to include them in the portfolio. Their bid offer spreads are too wide. So that's an obvious reason. But if they do become liquid, if they establish themselves, I'd be looking at them, and I'd very likely add them to the portfolio, especially if they are additive in the sense that they're uncorrelated to everything else that I have. And the other reason is that I would remove a market from the portfolio is a persistent structural change in the market. I can give you one example really only where I did that, and that is European dividends. Not exactly the most liquid futures markets in the world to begin with, but liquid enough. And European dividend futures had an interesting tailwind to them, in the sense that they were, you could argue, trading at a discounted level because there was a naturally motivated seller of these dividend futures, which used to be, still is to an extent, but a much smaller extent now, investment banks that had issued structured notes with dividend risk. And these banks were using, or are using, these futures markets to hedge some of that risk, and that made them seller of these dividends. They have in recent years changed the way dividend risks are incorporated in these structured notes, which is a big chunk of the market, and therefore that natural tailwind has disappeared. That discount to fair value has arguably disappeared. And that therefore made that market, in my opinion, much more like a Eurostoxx 50 equity beta lookalike, with higher trading costs and less bang for the buck. And that was the reason why I removed it for the time being. Maybe at some point that'll change again, and I'll be putting it back in. But for now, that one's gone. But all the other ones, I'm really much more focused on adding stuff to the portfolio than removing things from it.
Yeah, and as the years go on and as portfolios grow, there's certain things that happen, like you said, liquidity. You certain products you may not be able to trade. I don't know if you're at a point where, can you still trade lumber at the point you're at?
Yes, you can trade lumber.
You can still
Again,
trade
this is one of the smaller markets, but it is a futures market. They have changed that contract
Yeah, it
last
seems
year, I
better since
think.
we went to LBR. Yeah, it seems a little bit better now, a little bit more liquid.
So yeah, that really depends on your size and your willingness to pay for exposure by having a greater roll cost or potentially more slippage and wider bid offer spreads. But when you then put that into perspective, or see that again, frame this against your expected hold period, whether I'm losing another tick or two or maybe 3 on a trade, which, I can hold for days and weeks and months, like whatever, 200 days on average or longer, in my case, then 1 or 2 or 3 ticks of extra slippage really doesn't matter that much. If I ran a system where, oh yeah, I'm kind of like out today, tomorrow, or at most in, 3 days time, that starts to matter a lot. But that's not me. So I can tolerate these smaller, a little bit more expensive markets to trade way easier given my AUM, because I don't need to go in there and lift 50 lots, take liquidity at market. That's not what I need to do. I trade much smaller. And then, when you think about it, lumber is by the way, lumber, one of the markets which went completely crazy during the COVID period. There you have it, right? I mean, one trade like that, one lumber trade like that is worth a ton. So yeah, not having these markets means that you're not in a position to participate in the outlier price move.
Yes, and that was another one that went pretty crazy in that quarter too.
Mhm.
And for me, my size, it's easy to trade lumber, but I know there's people that are to the point where they can't trade it anymore, and that's why I wanted to ask that question. But going through all these, there's just so much
And
interesting
and
stuff about the
to
trend.
just add to that, this is
Go ahead.
also true for cocoa. Not everybody trades cocoa. Some of the larger funds
Mhm,
wouldn't trade cocoa because it is not the largest commodity. It's not the most liquid commodity market. It's one of the smaller commodity markets.
mhm.
In fact, the standard, shall we say, or one of the main commodity benchmark indices, the BCOM index, the Bloomberg Commodity Index, doesn't even include cocoa.
Yes.
I had a look because I kind of wanted to figure out, like, there's a roll coming up, like, to what extent maybe is the May contract part of a big commodity index. And so I just figured, oh, it's not even part of the BCOM index. It's part of the GSCI, very small weight. So that just goes to show it's not a big market. And some of the larger trend following funds may actually not trade it. And they're not trading palm oil or orange juice or cornello and oats and lumber and like all that type of stuff because, yes, they'd be too big for that. Or they would kind of like have to give that market now a very different weight than everything else in their portfolio, which again has consequences on sample size because you're now making an active decision to trade something smaller versus the rest, which essentially means that you're saying that you're not expecting it, you're giving it less of a profit and risk potential. You're essentially saying that you're not expecting it to do that well. So you may as well then just not do it.
Yeah, and I also, now on that same subject, I looked at what I was looking at here now. I'm bringing up DBA. So DBA, that ETF, it actually buys cocoa, and it has a pretty. I looked at it the other day, and the weighting was huge. I'm going to try to
Oh,
bring it
really?
up here for a sec.
What
Yeah,
is DBA?
it's a commodity ETF for agricultural commodities, and the
Okay.
cocoa future weighting right now is 21% of the fund. Um, in
Well, is
live
that
cattle,
because the price has increased?
yes, because the price has increased so much. So the weighting is 21%. And I remember looking at this years ago, and cocoa, I don't even know if it was on here at the time. And cattle's also on here. Those are two markets that went pretty crazy recently. So the weighting on those are pretty large right now. So it's going to be interesting to see where that goes, because that ETF, the last time I looked at it years ago, was mainly soybeans, corn, most of
Hmm.
the agricultural commodities. Now you're looking at it and you're seeing all the leaders kind of being the top dogs in there, which I something I've just not I haven't seen. I haven't seen that before. So
What
it's
are the
very
AUM of what are the AUM of that ETF?
I'm looking at the holdings and weights. I don't know if it's going to give me the AUM. Yeah, I'm not sure. Yeah, it doesn't say that on here. But yeah, it's quite interesting to see that this is, cocoa being the top holding in anything, like it's wild. But at the same time, I guess it's the top holding for people like us right now too, because it's gone up so much unless you've cut down the position.
Yeah,
Um,
it's the thing
so,
that moves the needle.
yeah. And I really do, I like the fact that people are getting more interested in the commodities markets the last 4 years. People really weren't very interested in futures, not even trying to understand it. And, there's just so much diversification in it. And I think the thing that would be a good question for you, something I try to explain a lot, but you might be able to explain it in a better way than I can, which is when you're trading something like you talked about earlier, you have cocoa and you have London cocoa. But what about, let's talk about heating oil, gasoline, and oil. When you're trading all three of those things, how do you set up your risk management there? Do you trade them all the same size? Do you cut your size down on each of them because they're so correlated to each other? What do you do there?
Yeah, and Chicago summer wheat or soft red wheat, and Kansas hard red winter, and European
Yes.
milling wheat, and um, spring wheat in Minneapolis. Like, all of these markets are correlated positively most of the time, and persistently strong positive correlation. So when you see um, crude and Brent, even a better example, right? Kind of like tied to the hip. But there's no guarantee that that will always be the case. And this is why I include them in the portfolio. But yes, to your point. So something like New York cocoa and London cocoa. What I could do, just for argument's sake, is say if they were really like correlated with one, the same thing, then by definition, there's no point trading both. But let's just say that they're very, very highly correlated. And you could therefore say I'm trading half a risk size in London cocoa and half a risk size in New York cocoa. Just for argument's sake, for the ease of calculation, imagine we're risking 50 basis points on each trade. I would now risk 25 basis points on London cocoa and 25 basis points on New York cocoa if they had a correlation of one. Now, most of the time, right now, they're pretty much correlated by one, but they're not always correlated by one. And there is a chance that they may decouple and that one of these markets does something very different than the other, in the same way that, London gold and New York gold had decoupled, even though it's the same commodity. So that means that you can, and this is how I view this, trade each of them a little bit larger than the 25 basis point. You can trade each of them, say, with 30 basis points risk for a total risk budget of 60 bips as opposed to 50. And this is not an exact science. And I refuse to kind of like laser point that with all sorts of correlation analyses, because I think you probably just trick yourself into figuring something out that's far too complex. Just recognize the fact that there are some markets in your portfolio which kind of like come from the same family tree, the same barrel of oil, for instance, in the case of the products and the distillates, and that there is therefore positive correlation between them, but also recognize that that correlation structure can break down and that these markets can develop their own outlier behavior. Heating oil and gas oil, for instance, gas oil in particular, was a great example during or after the Ukraine invasion. The diesel shortage that was, kind of like a risk to the European continent, showed up in the gas oil contract, which then, morphed over to the New York NYMEX heating oil contract. And these price moves were much more amplified, much more severe than what you saw in crude itself, be that Brent or WTI. So there you have it. It's kind of like, most of the time doing the same thing, but then boom, they don't do the same thing. Another great example is wheat. Yes, most of the time, European wheat does exactly the same thing or kind of like the same thing as US wheat. But when there's a risk that there's no wheat coming out of Ukraine, that relationship all of a sudden changes. And that is exactly when you like it as a trend following trader to have your risks spread and split across these different markets, because one now gives you the massive outlier opportunity and the other doesn't. And that's valuable.
I agree completely. It's you just never know where something's going to end up. And I think just the way of setting it up, I do the same thing where it's like I'm going to take a little bit smaller size, I'm going to take a little bit less risk. I have, heating oil, gasoline, oil. When I have all three of those on, the sizing is just going to be a little bit different, but I still will take all of the
Mhm.
trades because you never know where that outlier could come from. I remember, I think I started doing that because I think it might have been Jerry. I'm not sure who. I think it was Jerry talking about when he was with the turtle trading program, and there was heating
Mhm.
oil. There was some issue with heating oil.
Yes, he
Um,
mentions that.
yes, some issue with heating oil, and he ends up talking about, like, the insane trade that happened in heating oil while oil didn't move at all. So it's important to have that diversification if you can. Some people, as you're just getting into futures and trading, obviously sizes are big. You may not be able to have that type of diversification at first, but over time, when you're growing your account, like, you have to start to have the diversification because you could have that crazy outlier event. And those
Yeah.
outliers, that makes your whole year.
Right, and there's really no reason not to do it. The computer does the work for you. You're just, computing another market, and that market produces a signal. And depending on, how you trade it, whether you still use the mouse and point and click and put the order in, or whether you route it through automatically with your code base, at the end of the day, even that doesn't matter. It's a relatively minor task to trade another market, I'd say. And therefore, not doing it means, to me at least, that you're leaving diversification potential on the table. And diversification is a free lunch. It is something that helps your portfolio. It is something that makes your portfolio better and stronger and more resilient. And every iota and every basis point of diversification benefit that I could possibly squeeze out of the markets for free, I want to go after, and I kind of like feel irresponsible if I didn't.
Yes, and I mean, in general, diversification is incredibly important. However, you're looking at trading in your portfolio. I love it as a futures trader because I have access to different asset classes. I've had plenty of time. I mean, we're talking about Q1 22. That was a time where stocks stopped moving, started moving back into a downtrend, and the commodities made most of our returns. So, just having that diversification can really put you into different areas. Not to mention, let's say you're just a long-term investor, you can diversify in other ways. Let's say you're just a trader and you've made some money. Well, you don't want to, for me at least, I don't want to have all of my money in my trading account or all of my money in a fund. I want to diversify. So maybe I buy some commercial real estate. Maybe I invest in some gold. Maybe I do IRA here or something. Like, you can diversify in many different ways. But for what we're talking about in trading is uh, adding all of those products will give you a better way of doing this than just saying, hey, I'm going to trade oil, I'm going to trade gold, I'm going to trade, no silver, no platinum, no nothing, because I don't like silver, platinum. You start to pick and choose at a certain point. And
Yeah.
in reality, like, the more diversification you have, the more you're ready for those outlier trades, the more things like cocoa happen. Like you said, we talked earlier, people getting out of that one thing because, hey, it's been choppy. Hey, it's been rough. I had a rough time trading it. I don't want to
Yeah.
trade it
Yeah.
anymore. So
Don't cherry
having a
pick too
diversification
much.
gives you that
And
outlier.
that's right. Don't cherry pick too much. And, hopefully these futures markets will grow and develop even further. Obviously, that'll invite more competition, but there is a futures contract on high yield, iTrax, on CDX, on investment grade. There's a futures contract on the Dow Jones Real Estate Index. Maybe at some point there'll be even more specifically something that's liquid on real estate or on mortgages. All of
Uranium,
that
I
type
always
of
thought that'd be a fun one, but it's too liquid.
uranium.
Yeah.
I mean, there's an ETF. We just don't know. Maybe at some point lithium will come up. There are some very interesting futures markets onshore in China, which are relatively, I mean, it's a possibility to access them with offshore money, but it's not without risk. But look, I mean,
Water.
yes, the more the better. That's it, right? So you can, if we weren't constrained with the futures, say you're setting yourself up as a fully opened up hedge fund, like a macro fund that can do kind of like whatever, no managed accounts, none of that type of stuff. You just have one fund and strong, prime broker relationships. Then through these banks, obviously you then have to control counterparty risk, and obviously nothing's for free, but you can access some different risk factors in addition to the futures that we trade through them. Think about mortgage-backed securities and all that type of stuff. That just you could probably trade that unfunded with a PB, and it's nothing that we can do right now on futures. So yeah, there is a great spectrum of opportunities and markets out there, and it's one of the things that motivates me, and I find it extremely fascinating, is to get to these markets, to understand them, to analyze them properly, properly research them properly, not just trade everything off the cuff only because it shows up on the screen. Understand what it is that you're doing, but when you find something that is liquid, that has a benefit to your portfolio, I really say just, yeah, go for it. There's no reason not to.
Nice. So, one thing to ask before we get off, if you were talking to a new trader that was having trouble with discipline and they were
Mm.
looking into trend following, what would you tell them? Maybe something that you wish you heard as you just started to get into trend following trading or systematic trading. What's something you would tell them for advice?
Yeah, I lost you there, Jason. I'm sorry.
Can you hear me
Are we
now?
back? Yes, I can hear you. I
Okay.
think you asked me, what is there anything that I wish somebody had said to me when I set out with the trend following trading?
Yes, something that you would tell yourself, as you just started getting into trading and systematic trading and trend following.
Patience. Patience is so difficult to learn. Most people aren't patient. Um, it is something that you have to kind of like become over time. Certainly, I'm sometimes not the most patient person in the world, but it is like many other things in life, a skill that you can learn, that you learn over time, because everything feels so important and so fast and so relevant in the moment of now. The only thing that's on your desk today is what's happening today. You're looking at the markets today. What happens to cocoa today is kind of like what you think matters. um, your weekly performance matters. Your monthly performance matters, right? So you kind of like, you look at 1 month, 2 months, 3 months, especially if you're underperforming your peers, you kind of like take this too hard. You almost book it like a failure. Like, somebody is winning the race and you're lagging behind. You must be doing something wrong, all that type of stuff. In the bigger scheme of things, if you're planning on being a success, well, everybody wants to be a successful trader, but if you project yourself forward, say 20, 30 years into the future, still with a track record, hopefully at that point in time,
Mm.
the 3 month you've had at the beginning of 2024, you will probably not remember them. And
Yeah.
they will be a very small part of what it is that you have done. And so therefore, kind of like stepping back and being patient with these markets and with your good systems. Obviously, don't be patient with losing trades and systems that you shouldn't be trading. But other than that, just focus on the next trades, do them, and kind of like forget about the daily noise and the daily performance, and kind of like the race. Focus on what it is that you can do best. And um, I would say that is one of the reasons why trading is a thing that can be taught and it can be learned. Obviously, there may be some people out there in the world who are so gifted and born with a specific skill that makes them great traders. But I would say, like the turtles, you can learn it if you focus on it. You know the core rules, the principles of keeping losses small, letting winners run, trading a lot of markets, then this is something that you can get to. Not overnight. It'll take some time, but it's not impossible.
No, I love that. It's so important to just grasp that one fact of patience. So I'm glad you said that, because I think that's something I see more than anything else, is like people underestimate. It's whatever it is, whether it's a podcast, whether it's a business, whether it's trading,
Mhm.
people underestimating what they could do in 10 years and overestimating what they could do in 6 months. As a trader, you keep that system, you keep that track record, and you keep building it over time. If you have a good system and you figured it out, you will forget all those losing periods, and none of that will really matter. And also, like, I think something that really helped me was I don't ever focus on my weekly, monthly returns. Quarterly, I do look at it, but it's also not my primary focus. It's the year. Like, how am I doing on the year? Like, that's something that I really try to
Yeah.
focus on. So I'm not stuck in this, hey, I got to do great every single day. Hey, I can't believe I didn't make money this week, this month. Like it's a ridiculous
Yeah.
thing, because the market's not going to always be conducive to any of our
Yeah.
strategies all the time.
Imagine, I think it would actually be almost helpful, like, the private equity venture capital type of trick of volatility laundering and not marking things to market, and kind of like almost finding your own market. But not essentially reporting the current net asset value of the portfolio. Like, if I just say it's New Year's Eve, and I just give the system to somebody I trust. It's like, you implement exactly what that system tells you needs to be implemented in terms of trades and positions. Here's the code. Here's all the infrastructure. I really don't have to. I'm not doing anything this year. I'm chilling out on the Maldives. I'll just do something else. I don't even want to be updated on stuff. The only thing that you need to send me is next New Year's Eve in 365 days, a fact sheet with the annual performance. I'd like to review what has happened, what drove the markets, what drove the performance, what was the attribution, how many trades did we do, all that type of stuff. And obviously, I want to see the annual net return. And then we repeat this. So I would only look at the thing once a year. Then it kind of like it shows up like plus 20, minus 10, plus 30, plus 5, plus 15, minus 10. So that you would be super cool with that, right? Or I would be super cool with that, because then it's like, yeah, it kind of like works most of the time. And sometimes it's even amazingly positive. So you should really just do that.
I mean, it's honestly what, once again, it's a thing that I always think about would be amazing with clients, is to just like, hey, once a year you get the, like we're going to stop
Mhm.
this monthly, quarterly thing. We're just going to do it once a year. And like, really, like, that's all. What else matters? Like, none of that matters. The in-betweens and the rough days, like, it doesn't matter. So you have to like figure out a way to change the way you
Yeah.
look at things. Richard and I talked today, and it's funny, I posted this. I write a letter, and yesterday I wrote about a queen bee that it was not a queen bee, well, it's queen yellow jacket I found in my yard. And I really like, I have an affinity for bees. I really like bees. So most people think yellow jackets are the scariest thing in the world. I my whole life was scared to death of them for the most part. And then, but I never wanted to hurt them or anything. I just knew they scared the crap out of me. And then you find out that they're actually very useful in the garden. Like this year, whatever we had, we would see we had all these tomatoes and we'd see cucumber beetles on them, and then we'd see the yellow jackets go and eat the cucumber beetles, and you're like, oh, they're keeping them in check. So they'd keep the hookworms in check, and the beetles, and like every bad bug that we didn't want on our food, they would get rid of them for us. And then also they also recognized faces. So understand that they recognize faces. They were always very calm around me. They never stung me. They never did anything to me. And so you start to learn certain things over time, and you shift your mindset or the way you look at things. And I think that's important to think about when, like, you have to shift your mindset about things like that. But also, like with trading, like, you have to understand your losses or your losing months, or the idea when you're a new trader that you're going to I mean, it sounds insane now, but that you're going to continue to take money out of the market every week like it's a job, like you're getting a paycheck. Like, you got to let go of all those ideas, because none of that's true. The market's conducive to your strategy at certain times, meaning that you might make zero or completely flat for quarters or years or whatever, and then the market could be completely conducive to your strategy and you could make all the money in the world. But it doesn't work in a straight line where you're going to be able to pay yourself from it. And you hear that all the time. People are like, I just want to pay myself from trading or something. You always hear those things. So it's really wild to think like that. So people just need to change their mindset. So I like that you said that.
There's a good, I mean, maybe this is the concluding thought on this, is like the stuff that we trade, you trade, I trade, Jerry trades, Richard trades, all of that is liquid. We could essentially liquidate our portfolios in an afternoon and T+2, or at the end of the month, return the money to our investors. There's no structure, no security that we are holding in our portfolios that's illiquid, where we just, couldn't get out or anything like that. So now, therefore, it's kind of like a given, or it is expected, that we're offering monthly liquidity at the minimum. There are some funds out there, ETFs, obviously, with intraday liquidity. Some funds have daily liquidity. Right. So, and that's fine. That is possible. It also means that what we've seen, and I think we're continuing to see, is this, we're all our own worst enemies. Some allocators and investors are, which means they're buying the top and they're selling the bottom. I think we spoke about this last week, is you start with a long-term investment horizon, and as soon as you have a drawdown or a little bit of a larger drawdown, that time horizon changes. It's no longer long-term. It starts to become medium-term and short-term, and then you get fired, and the investor sells the investment at a loss and misses out on the recovery, which is why we always say a good thing to do, or a good investment strategy, is to buy a good CTA in a drawdown. Now, I was kind of like, when you think about that paradox on, it's, even though we have this very liquid underlying portfolio, maybe we should, in full recognition of that, think about ways to say, look, here's a share class which doesn't have monthly liquidity. We're either going to offer like a share class with a 2 or 3 year lockup. Okay, we'll show you a monthly NAV or something like that, but you cannot redeem. Or we'll create a share class that only has like a quarterly or semi-annual NAV. If you want, it does have kind of like a soft NAV you can get out, but there's a higher redemption fee. So it shouldn't be as us just sitting on the money so that we can take some fees out. Maybe we need to take the management fee down or something like that, but essentially create something that is an alignment between us and the investor, in terms of, let's make this a longer term investment, but we also don't want to structure it in such a way that we look at, we're just locking people up for the only reason being that we want to take management fees or something like that. I wouldn't like that.
Yeah.
But the idea in and by itself, I don't think is a bad one. Or have a closed-end fund where it's kind of like, starts trading at a discount, whatever, like, Bill Ackman's fund. But essentially, yes, you can, if you want, get rid of your investment, but you have to find somebody else on the exchange to sell it to. You're not going to sell it back to the fund management company, or make the redemption in the market.
Yes. No, great points. I mean, this is such a fun conversation. I'm so glad to get you on again. Thanks for being so generous with your time the last couple of weeks, and coming on last week and this week. This has been a lot of fun. I always enjoy talking to you. Always enjoy listening to your podcast as well. Where can people find you, Moritz?
Pretty easy on Twitter. It's at Moritz Seibert. I think it's if you type in my name on LinkedIn, it'll pop up. You can find me on the website takahe.capital. That's TAKAHE.capital. Put my name into the Google window, and it'll find something that'll point you in the right direction.
And then you have the podcast.
Mm-hmm. Yes,
what's the name of the podcast so people can find it?
Yeah, it's a series on Top Traders Unplugged. It's called Open Interest. So if you go to toptradersunplugged.com,
got to freeze. Oops, Moritz froze there. Let's see if he can come back. Moritz looks like he froze here. So, all right, guys. Well, we're going to end it there. Thank you guys so much. This will be all shared to our YouTube channel. It'll also be on Twitter. Also be on Facebook for whatever reason. There's nobody who oversees that, but it'll be on all of our platforms. And then Moritz is back. There you go.
This is killing me.
No worries. It was good the whole time, really. It's just that one freeze.
Okay.
So.
All right. Well, I think we're good anyways. But yeah, I spoke to Tony Kaiser this morning, which was a fun conversation. One of the short-term systematic trading veterans in our space.
That's going to be cool. I can't wait to check that out. So, all right, Moritz, thank you so much again. As always, phenomenal to talk to you. You're a great mind in this space. Thank you so much for coming on. And we'll talk soon, I'm sure.
Thank you for the invitation, and thanks for all you do. Thanks, Jason.
All right, thank you.
Bye-bye.